This has been an incredible 2 weeks here, not only because of the human toll here and all of the fears we have about warfare, but the economic ripple effects. We're starting to see that both from the war and the economic sanctions.
Yeah, well, Romain, this is clearly a stagflationary shock. I mean, just like COVID, this is an unprecedented situation. So the next big shock, this war is clearly stagflationary. So it's pushing up energy prices. It is aggravating the supply disruptions. There are actually new supply disruptions, both in the transport of oil from Russia, but also in land transport, for example, from China to Europe, which partly goes via rail through Russia. So that's been blocked. So it's clearly inflationary in the near term. And it is stagnation or even recessionary, particularly for the European economy. So obviously Europe will be much more affected by this than the US. But even the US is not immune from this shock.
Mona, are you also thinking about stagflation right now?
You know, I agree with Joachim that this shock has stagflationary impulses to it. But I also would emphasize the global disparity that we're seeing. Clearly, the U.S. coming into this crisis was likely in better shape, both from the health of the consumer and the health of an economy overall. Keep in mind, the consumer is still flush with cash from the COVID pandemic stimulus, about $2.5 trillion in excess savings from the consumer in the U.S. To deal with the higher oil prices, the higher food prices, and some of those supply chain shocks that Joachim alluded to. We're seeing this play out in markets as well. We're seeing Europe, which is more exposed from both energy and trade to the Russia-Ukraine crisis. European markets have been down 8-9% this week alone versus U.S. markets down 1-2%. We're seeing credit spreads really widen more dramatically in Europe than in the U.S. And so generally, I'd say when you list those flight to safety asset classes, perhaps more broadly, the U.S. asset class in general has become a little bit of a safety play here as well.
The reaction, though, Mona, to geopolitics, there's always been this discussion here that there's a knee-jerk reaction and things sort of smooth themselves out. Things feel a little bit different this time with regards to the way people have positioned.
Yeah, absolutely. Look, I think markets never like uncertainty. We know that. And we came into this crisis actually with two overhangs. One, what is the Federal Reserve going to do? And two, how will this war in Ukraine now play out? Of course, we got a little bit of clarity from the Fed this week and Jerome Powell. Markets are still waiting for clarity from this overhang. How long will it take? How high can oil prices go? Really, what is the off-ramp here? And so in that those buckets of uncertainty, you really have to think about during this period of time. It really does make sense to perhaps, hide out in some of those safe haven plays. We've seen gold, the dollar, treasury bonds, all really that flight to safety asset class. Until we get clarity, and we're hopeful when you look at history, geopolitical crises do tend to resolve themselves over time and usually within a quarter or so. And so once we move past this, we get a little bit of clarity, we can then start to handicap what those stagflationary impacts will be on the economy and which economies will suffer more or less.
Well, Joachim, how are we looking at the global economy now? It seemed a few weeks ago there was at least some discussion about some degree of synchronization with regards to the economic picture here. Do we now need to start thinking of the global economy in different blocks in a way that maybe we weren't prepared to do a few weeks ago?
I think we do, Romain. I think what we're seeing here is more differentiation between growth and maybe even inflation outcomes between the US and Europe. The US economy is obviously still very strong. The payroll report today confirmed this. Europe was just about to reaccelerate. Demand was about to reaccelerate as the economy has been reopening after the Omicron wave has been subsiding. Now, there's a big question mark over that. I think there is a risk of a technical recession in Europe later this year, the longer this conflict in Ukraine lasts. And then you have China, which is, again, on a very different trajectory. China has been slowing quite sharply over the past year. It has recently eased policy. So you also have a policy divergence. The Fed is starting to hike rates, whereas in China, monetary policy has recently been easing. There is also fiscal easing, there is credit easing going on, and we could see a slight reacceleration of Chinese growth in the course of this year. So this is really a very differentiated story around the world.
Yeah.
We're really on very different tracks between Europe, the US, and also China.
If we do start to see a significant downturn in both Europe and in China, Joachim, how much does that drag down the U.S.? Is it going to be a little bit different than maybe what we saw in previous cycles?
Well, I think it's definitely a drag on U.S. growth, but not a very large one. The reason is that most of the growth acceleration in the U.S. this year is driven by the reopening of the economy, by pent-up demand that is still there, by a very strong labor market that is supporting growth as we're creating more jobs. So this is much more led by domestic demand than by global factors. Also, the US is a net exporter of energy these days. So while higher energy prices hit consumers, at the same time it benefits the energy sector in the US. So the overall effect on the economy is much, much smaller than it is for Europe and also for China and other oil importers. So I think the US is not immune, but it will clearly outperform both Europe and also China this year.